Hello everybody and welcome to this second lecture of Unit 2 in the Ethan Trades Mentorship. In this lecture, we'll be diving deeper into the different types of market conditions and explore the fractal nature of price action. When it comes to market conditions in technical analysis aspect, we are really looking for only two things. The market is either going to be trending or it is going to be consolidating. In a trending market, prices move consistently in one direction over a sustained period. Trends can be upward, aka bullish, or downward, aka bearish. These are the market conditions we try to capitalize on. You will often hear me referring to this market condition as an expansion. In a consolidating market, prices move within a defined price range or channel, without establishing a clear trend in either direction. This is also known as sideways or range-bound markets. During periods of consolidation, I like to wait and anticipate the following expansion. As this mentorship moves along, it will all make sense, but for now you just need to know what each market condition is. Here is a diagram of a bullish trend. You can see that price is clearly and consistently moving in one direction. In this case, it's consistently moving bullishly, meaning it's consistently moving upwards. An uptrend will consist of higher highs and higher lows. So here you can see you have a low and then you have a high. The next low that gets created is a higher low to the prior low. The next high that gets created is a higher high compared to the prior high. So you have a low, a high, higher low, higher high, higher low, higher high, then another higher low. So it's just consistently moving upwards. Now you might ask me, the market isn't moving in one direction. There's a bearish price move right there. Well, the idea behind a trend is that it is consistently moving in one direction, not only moving in one direction. So these small down moves in comparison to the consistent up moves in the market are referred to as pullbacks or retracements. So this little down move right here in this overall uptrend, right? This little down move is referred to as a pullback in the markets. An analogy I like to refer to for pullbacks or retracements is that think of price movement as a person swimming upstream. When they're actively swimming, they consistently make progress towards their destination, but occasionally the swimmer needs to take breaks. And that's why there are setbacks in the progress. So let's say the swimmer is trying to swim upstream, right? And the stream is pushing them downstream. Okay, let's just use that as the analogy. So they're swimming upstream, so they're making progress, but they get tired and exhausted right here. So the stream pushes them back. They need to breathe and rest. And then once they're ready, they start pushing again. And then over here, they run out of breath again, for example, and they need to rest and breathe, where you have the market pushing them back down, or the stream pushing them back downstream, and then they try to swim up again, and that's pretty much the analogy. Moving back to price action, one thing I do want to mention is that if you drop down to a lower time frame, then the down moves would be their own individual downtrends or bearish trending market of their own. This ideology of how price exhibits similar patterns on all time frames is the fractal nature of time and price. A great example of the fractal nature of time and price is to refer back to Unit 1 in candlestick anatomy. If you recall, the weekly candle was broken up into the daily candles, which were further broken up into the hourly candles. And you could do this so on and so forth. You can either combine candles together to get a larger time frame, or I can break them up to get a smaller time frame. So in this example here, I've annotated this uptrend. Let's say it's the daily chart. Then if we were to zoom in on this little pullback right here, this little retracement here, if you zoomed into the hourly chart, it would look like a bearish trend of its own. And here is a bearish trending market. Once again, it's a bearish trending market because it is consistently moving lower. A downtrend will consist of lower highs and lower lows. So here we have a high, and a low. The next high that gets put in is a lower high compared to the previous high. The next low that gets put in is a lower low compared to the previous low. You have a lower high, then a lower low, then another lower high. So just consistently moving lower, which is why it's a bearish trending market. And so here is the bearish ideology behind the fractal nature of the market. So the small up move within the larger downtrend is a fractal uptrend on a lower time frame. So once again, this is just the same as the bullish example, but now we flipped it around where this pullback right here is going to look like this on a lower time frame. So imagine this was a daily chart. If we zoomed in on these two on a lower time frame, it would look like a bullish trend of its own. So next is a consolidating market condition. Before we move on to the fractal level of a consolidation, here are 3 different types of consolidations you will find in the market. So first, you'll have a range-bound market, which is when price is just bouncing between 2 price levels. Second, you'll have the seek and destroy condition, which is when price is constantly taking out highs and lows in a widening wedge pattern. And third, you have the compression condition, which is when price is constantly failing to take out highs and lows in a triangle pattern, or it kind of looks like it's forming a flag, a triangular flag. So often you'll hear me referring to price in live streams to one of these conditions when I expect consolidation. So for example, I'll be prices in compression right now, and I'm really referring to this right now, where it's consistently failing to take out prior lows and highs. So here we can see range bound, it just makes a low, a high, and then makes another equal low, equal high, equal low, equal high, equal low, where price is just pretty much respecting 2 specific price levels, bouncing back and forth. In a seek and destroy condition, we call this seek and destroy because people that sell at this high right here, their stop loss is going to be taken out on the next higher high. So they actually lose money, they get stopped out of the market once this high is taken out, right? So vice versa, the low, let's say someone entered a buy here, they're making money, but they hold the position and they get stopped out at this low. That's why we call it seek and destroy, because everyone is pretty much seeking and destroying everybody's position. So it would be a low, a high, a lower low, a higher high, a lower low, higher high, lower low, where it's like a widening wedge. And then lastly, once again, the compression, where it's a low, a high, a higher low because it fails to take out that previous low, and then a lower high because it fails to take out that previous high, a higher low, a lower high, a higher low, where it's kind of creating like a triangle pattern here. In this specific diagram, I have delineated 2 price levels to show you how price bounces in between them. So this one right here would be a range-bound market. Although it may seem like a bad idea to trade these conditions, going back to the ideology of the fractal nature of the market means that each leg of price you see here is a lower time frame trend that is definitely tradable. So if you're able to identify a higher time frame consolidating market, it's very easy to make lots of money on a lower time frame of that higher time frame consolidation. So here is the consolidating market condition with the fractal aspect of it. So once again, if you were to look at this consolidation up here as a daily chart, right, we're just constantly bouncing between 2 price levels. Then we looked at this right side as the hourly chart. If we zoomed in on this little up move here on the daily chart, on the hourly chart, it would look like an uptrend of its own. So by identifying consolidating markets on a higher time frame, it's very predictable when to expect up movement on the lower time frame or down movement on the lower time frame, and that's why we're able to capitalize a lot of money off of this. So for a moment, I just want you to imagine if the market right here, this up move right here, if this was let's say it's the yearly chart, right, and you understand that the market is just consistently moving higher on the yearly chart, then a long-term investment wise, let's say this chart on the right side was the daily chart, then you would understand that because the yearly chart is consistently moving higher, it's easily predictable for a long-term investment that you can buy at somewhere in the low or somewhere in the middle here and hold it for multiple years and then eventually sell it, right? So that's pretty much what we're trying to identify here, is we're trying to identify what the higher time frame is doing and trading the lower time frame in context of the higher time frame so that we have high probability that the market is going to move in our favor. Now that you understand the 3 market conditions of how price behaves, imagine each market condition as a piece of the puzzle. The market is only ever doing one of these 3 things. In the diagram I've created, all I did was take one of the 3 market conditions and pieced it together. So here we have a bullish trend, right? And then the market consolidates. Then we have a bullish trend once again, and then it consolidates once again. And from here, we have a reversal occur, which means the market was originally moving higher, and the reversal is pretty much just price moving the opposite way. So once we have a reversal, market starts trending lower. And we'll get into some live examples here. So moving on to the live example, each shaded area is a different market condition. In the next lecture, we will cover more in depth about the different types of price delivery the algorithm can do. These would include expansion, retracement, reversal, and consolidation. But once again, for now, I'm going to keep it simple and just show how the market moves. So here you can see that the market is either only trending or consolidating. One thing I want you guys to note down is that before each trend or expansion, there must be a consolidation, or 95% of the time or more, there's going to be consolidation. The market won't just expand and expand again. So here, let me show you. Here we have a consolidation, and this is how we're going to anticipate these explosive moves in price. This is the move that we want to capitalize on. This green box and this red box. These are the moves we want to capitalize on. We want to buy near the low here and ride it higher. And then we want to short or sell at the top here and ride it lower. That's the end goal. These consolidation phases are what we're generally trying to avoid, unless you're able to identify, once again, if you're able to identify the consolidation phase, then you could go down to a lower time frame, and these little moves in the consolidation would look like clear trends. So consolidation, bullish trend here, which would be your expansion. Then you have another consolidation here, and then a slight up move. So this up move right here is called a manipulation leg. So this up move is purposely put here by institution so that it fakes out traders. So here, this move, the purpose of it is called manipulation because the purpose of it is to make traders feel like price is going to move higher. So this slight up move here is to make everyone feel like price is going to go higher, and then we have lower prices. Later on in this mentorship, when I explain liquidity, this will all make more sense. But for now, once again, we are just identifying the different market conditions. So we have consolidation. From here, we turn into a bearish trend, or we have our reversal because originally we were moving higher. Now we're moving lower. After we have our reversal and expansive move lower, we'll have another consolidation. From here, we're expecting lower prices again. So here is a second example of that. Once again, we have consolidation to start everything off. From consolidation, we can begin anticipating some sort of expansive move, some sort of trend incoming. So right here, once again, we have consolidation, this up move to fake out all the traders to make them think that we're bullish, right? And then we start moving lower. Once we finish our expansion lower, we have a consolidation, right? And then we'll have a bullish trend as our reversal here because we were originally moving lower as our expansion. And then we have a consolidation. And then as we move higher here, that would be the reversal because we were originally moving lower, right? And then after that, we have another consolidation. So just think of it like this to simplify things. After each expansion in the market, you will have a consolidation. After each consolidation in the market, you will most likely have an expansion. And that's just how it works. It's very simple like that. In the next lecture, we will cover more in depth about the interbank price delivery algorithm, and that'll really put it in clear-cut words or clear-cut form what the market can do and what it cannot do. That's all for this lecture, and once again, don't stress too hard over this if you don't instantly understand how to spot the different types of market conditions, because with more time spent looking at charts, it will become second nature to you. As always, the homework and quiz for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity. Study and do the work honestly. I promise your hard work will be rewarded. Your assignment for this lecture is to go into your live charts and try to mark out different types of market conditions. I'll see you guys in the next one, and as always, have a great day.